Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project Podcast. I'm your host, Steve Fieros with Tri-City Equity Group. Today, we have Ray Hyman on the show. Ray began his career at JP Morgan, corporate and investment banking team focusing on U.S. REITs. He has loads of experience in private equity, acquisition strategy, deal structuring, portfolio management. He's currently the managing director for Terra Capital, the unique focus on repositioning many multifamily assets across key Midwest markets. Ray, welcome to the show.
Steve, thanks for having me. Great show, awesome content. And as I told you before we got started here, I've stolen a few things from it. So good stuff.
Hey, now appreciate you coming on. Excited to talk a little bit about your strategy, of course, and, have you share what you're doing with some of our, with our listeners. I think it's definitely a unique strategy and a great way to create a blue ocean, amongst, you hear all the different things out there with people trying to create unique opportunities for themselves. Or, hey, the market's too busy. Hey, I can't flip. There's a million flippers in my market, or, my market's saturated with whatever strategy that there is out in the world today. So excited to have you, share what you guys are doing. That's a little bit unique. And, but, first, before we kind of dive in, for our listeners that may not be familiar with who you are and kind of what you've got going on, give us a little bit, fill us in on your background, how you got started in real estate and kind of led you to where you are now.
Sure. And yeah, sometimes you can't find a lane, you got to make a lane, right? But time in here, I'm a Midwesterner. I'm from Cleveland, super hardworking parents, both own their own businesses, one of which is an architecture and construction firm, which is what got me sparked in real estate in the first place. And that was actually where all my summer jobs were growing up. So I got started pretty young and pretty hands-on there, unskilled labor. But I shipped off to New York for college at Columbia. That's where I met my absolutely stellar business partner, Tom Higgins. He is a developer by trade and just an absolute star in the renovations world. We started working together on real estate in the city during school, buying smaller properties in a few different neighborhoods. And that's what really, opened my eyes to the truly incredible opportunity in mini multifamily or lower middle market real estate, but smaller multifamily properties. Like you mentioned, I had some pretty serious jobs after school. I worked at JP Morgan. I was at Booz & Co., where I sat on their acquisition strategy desk, and I worked at Terra Capital, which is a private equity fund doing healthcare, tech, and real estate. But the whole time we kept buying smaller properties in New York, taking aspects and strategies from our day jobs and combining that with what we were learning directly in mini multi as investors, as managers. We bundled all of that collective experience together to form Terra Capital. And we've launched several funds focused on the mini multi space and are just continuing to build from there.
No, that's awesome. I mean, there's a couple of things there too. Like, I'd love to kind of dive in a little bit. I mean, for one, kudos to you guys for, for one, you had some, sounds like some pretty solid positions already kind of in the W-2 space and kind of the traditional finance world. Kudos to you for stepping out. Most people that are here, it's like they're afraid. Like, I can't do that, man. I can't leave the W-2. That's the golden handcuffs, so to speak. They'll trade the high ceiling for the security that you get working for some of these bigger firms. And two, man, you did something that I didn't do for a very long time. I'm based in Hawaii. We're thousands of miles away from where I grew up. I grew up in Texas, and I grew up in San Antonio. And you didn't overlook, the markets that you kind of spent time in growing up. And for the longest time, I did. I didn't start buying back in my home market until this year. And I'm kind of kicking myself. I'm like, oh my goodness, if I would have just bought, 20 years ago, started, who knows, maybe I wouldn't have left. That could have been a problem. So kudos to you guys for, identifying those key factors, let's say in your own home markets, to kind of stay in those different areas and really make a home, carve out that niche for yourself. So
I appreciate it. There's no place like home, and you're never going to understand those people or that culture better. You have to be able to do many other cultures and many other regions if you want to expand. But
Sure.
there is a significant home court advantage in real estate, especially.
Yeah, no, absolutely. Yeah, no, I fully agree. And like I said, you were carrying over the skill set. Not only did you not were you not afraid to kind of venture out, from the W-2, but you actually, okay. I don't think enough people ask, hey, is there anything that I do kind of in my daily job that can carry over, into something that I can do with a higher ceiling, to the benefit of my own, my family, my personal self, generations to come kind of deal. I think too often people overlook the skills that they're given that, hey, maybe companies have spent massive amounts of resources to develop, let's say the position that you're in, or at least the training or the systems and all that kind of stuff, to be able to apply. And then, you obviously saw that right away and say, hey, well, we can do this too.
Yeah, we both of us, both Tom and I, but myself especially, very thoughtful about what jobs we were doing in the lens of, okay, this is going to teach me how to do Terra Capital later. And that is born of the fact that I don't think I was ever meant to be a long-term employee anywhere. You can ask any of my former bosses. I don't think I was lacking in talent, but I'm a very bad employee. I like to work on the things that I think are interesting and go after the things that I think are promising. And the following orders component of it was never really my forte. So I picked up the experience that I could get and brought it to bear. But I, moved around quite a bit to learn what I needed to learn. Banking, consulting, acquisitions, PE stuff. And, so it's a good basis for any industry, and bringing it to real estate has had its benefits for sure.
Oh yeah. No, I mean, you're the second of a recent guest that I had, where we were talking about the same thing, to say, you know what, sometimes it's okay to admit, you know what, I'm not the best employee. I'm not cut out for that. That's okay. I think some certain people, like I said, they feel like they have to stay committed to this one job. Well, it's got to give me a chance. And hey, I totally understand that. But some of us are just not great. Some of us are not great employees, and it's not because we're bad people or bad workers or anything like that. But it's just like we don't fit into the standard box of maybe what these companies are looking for. So yeah, kudos to you for identifying that, and not feeling afraid to kind of break away.
Cheers, and likewise.
Yeah, well, want to highlight a little bit mini multi. I don't feel I feel too many people talk about that. Of course, I know quite a bit of flippers just through different networks that I'm a part of. Tons of people in the vacation rental space. Flippers, residential retail sales, all that kind of stuff. So in the single family, for those that may not be familiar, like what is considered mini multifamily?
Yeah, so I could take a quick step back and just talk about what Terra is doing to frame it up. But at Terra, we're focused on unlocking what we see as a tremendous amount of value that's really trapped in mini multi or smaller multifamily properties. And what we do, as to your point, is very similar to single family home aggregators in a lot of ways, right? We are buying, they will buy a lot of SFRs, they'll renovate them and then put them together in a portfolio that's large enough to become an institutional sized investment. And we're doing something very similar to that, but we're operating in the, quote, mini multi space. And so that mini multi space, or the lower middle market, whatever you want to call it, we define it as any apartment building that is sub 20 units. So really and truly the smallest apartment buildings out there. It includes duplexes for sure, but our sweet spot is really that 8 to 10 unit building. And this is the part of the market that we always refer to as being too big for flippers and too small for developers. And so if you think about that for a second, it affords us a tremendous competitive advantage, because other groups in this space, they're just not the right size to take down this type of deal. Either they're way too small and they're a local mom and pop and they can't do it at scale. Maybe they can do one, maybe two a year, but frequently overall, it's just too big a project for them. Or on the other side, they're a real estate investment firm or development firm that is, it's so large that they have a minimum check size that's way above the check for any of these properties. So they could never go after them. Even if it's an excellent return on equity, they could never go after it. So the result of that is simple economics, supply and demand. The demand is limited by the number of people that are able to do it. And so we end up getting incredible prices per unit. We buy about 20 units per month. And of course, we add a tremendous amount of value through renovations. And finally, we aggregate these assets into large portfolios when we go to sell. So we get that portfolio arbitrage or portfolio premium that goes along with building an institutional grade asset out of smaller assets. And that's, just like the SFR aggregators, but and there's a ton of details that go into that. But ultimately, at the end of the day, it's an asset class with unsophisticated sellers, mom and pop folks. You get a lot of people who forgot about their property. And when you're cold outreaching to them, you are reminding them of a problem that they had kind of brushed under the rug. That's the usual story. And we actually buy about 70% of our units truly off market. So our off market cold outreach approach is an important part of what we do. But it's not like single family home outreach where there's 6 people that sent them a letter and they're trying to decide who's going to get the right price. And it's individuals kind of running a bidding war over their home. It is instead this, underappreciated, frequently ignored asset. It's in a great location. It might have vacancy. It desperately needs renovations. And the people that own it currently aren't even close to being able to take advantage of that or do anything with it. So it's got a major value component to really every member of the real estate community, but it's a win-win for sellers. They save a broker's fee, they get rid of a problem they might have forgotten they had. And obviously for us to enter at such low prices per unit is huge for our model.
Yeah, no, it really is an underserved market for sure. For our listeners that are involved in multifamily and, you guys are familiar with, syndications and kind of some of the larger projects. We can definitely, you guys can attest to the fact that, most of, any syndication that you're seeing, it's too small. Like the cost, the legal cost is prohibitive for, getting into something in that, 8 to 20 unit range. It just doesn't make sense. And then for my all of our single family listeners, a lot of people just don't realize, hey, residential is still considered 1 through 4. That's for financing, in terms of marketing, the agents. I mean, you try to take a 5 unit, even though it's literally just 1 unit, to a residential, like a traditional broker, traditional agent to try to market, a 5 unit. They're gonna have a hard time doing it. I mean, because they don't know how to value it. They don't know understand how, let's say, the appraisal process happens, or like how the valuation is determined. And so they're kind of like, I'm familiar with the area. I know exactly the area. And I know that kind of product in terms of, build quality and all that, but they may not know how to position that properly in the market to allow somebody to come in and, an operator or, somebody on the back end investor, whoever, to come and take it over. So they're kind of you're in that gray area of like kind of a hard market to service. So I'm not surprised at all that you guys have, a tremendous amount of positive response really from, sellers and people who are wanting to kind of move on from some of these assets that are, hey, you know what, they have a ton of value in them. But again, there's not a huge secondary market for these guys until you have somebody like you that can come along, reposition them, package them together. And now they're incredibly valuable, right? And they serve a real needed place in the marketplace too. I mean, how many people are looking, let's say residents are looking for, hey, I just want a clean unit. I want a great location. And that's where a lot of these properties are. I mean, because they don't make that kind of stuff anymore. So, they're usually in areas that they've been there forever. Right.
On the tenant side of things, especially, there is an incredible demand and a ridiculously short supply of units that are in the space. And the way that we think about the tenant and what we're renovating towards is really, we're going after workforce housing, but it's the upper echelon part of that. So if workforce is 80 to 120,000 for the household per year, we're more in that 105 to probably 130 range. And we get a lot of nurses or groups of nurses, folks that are based in education, folks that have really good long-term kind of local manager jobs at a tech firm. Sometimes it's a Google type firm, but they're the medium cost location person, right? They're not the high flying programmer. They're the last to be laid off type person. They're just run of the mill, but well compensated, very sticky type folks, but they don't make $250,000 a year. So they don't want a really expensive $1,800 one bed apartment in Pittsburgh in a luxury development building. So what we offer is a 35 to 40% discount off luxury rents, but with the same finishes and a lot of the same in-unit amenities that a luxury developer will provide, right? I mean, you've got the same tile, the same high quality flooring, you've got granite countertops, you've got in-unit washer dryer, you just don't have a gym, right? But there's positives to that as well, is that, you're in the center of the really cool neighborhood, the really cool city, whether you're thinking about Williamsburg or the South Side in Pittsburgh, or XYZ in Austin, that is like the neighborhood where everybody wants to live. A lot of the properties there are mini multi, and the quality of those units is not very good, but there's a huge opportunity to improve them and really make something special out of it. But there is a massive opportunity in any space when you can find something where you can, put shortly, buy low and sell high, but with more complexity, get some level of portfolio arbitrage, get some level of flip arbitrage, whatever it is, and be able to really take advantage of a spread between prices in the market and a market gap. And there's a huge reservoir of folks and properties like this that need to be purchased. And then there's this incredibly competitive space on the back end that's institutional grade buyers, that anything that's 150 to 250 units and above is so hotly competed over, and that drives the price per unit so high that market's already there, right? But then the in between of actually aggregating that out of smaller units, it is, to your point, it's a wasteland. Whether it's the lender or the insurance broker, really every part of the real estate ecosystem and every different third-party component that you need to put a deal together doesn't exist in the right way for that property. They exist really well for single fams because everyone, including Zillow, is out there buying hundreds of them a day. And They exist really well for every property that's over 50 units because those are professionally traded by people that want those systems and buy and sell those properties every 4 or 5 years. But the in-between is really very ignored. So it is a big opportunity, but it's also a massive headache and undertaking to build out a model where you can take advantage of it. But at the end of the day, we're doing over 2.3x net multiple on equity to our investors and over 25% net IRR to them. So obviously it's worth it if you can do it right, but it takes a long time to put that together.
Sure. Yeah. And I'm sure I don't want to say not that it's a stretch because you guys are obviously doing the work, but the inventory is there, the opportunity is there, and you're obviously doing quite a bit of volume in order to hit those numbers. In some of these other markets, it's like, gosh, man, we got to sort through a lot of deals, to be able to hit a 2x. And just because, again, pricing has just been through the roof, in a lot of these markets now. So for the last stretch, but yeah, you go in and it's like, well, yeah, no, we just closed on however many of those things already. We're into Q2 now, and it's like, okay, well, yeah, we already got how many closings under our belt, I'm sure. Just because, again, there's a way more inventory out there. So, I mean, for our listeners, that are looking to, I don't want to say looking to get started, but if you've got some experience, maybe working on either side of the fence on these things, hey, maybe this is a strategy for you guys. Now, you did make mention too, right? There is a bridge there that needs to be built, right? So you're on the back end, happy to, because for those of you guys that may not be familiar, right? Ray just mentioned it. You have to have a large enough asset for, let's say, institutional capital to even come on the radar for you to even take this to capital on the back end on kind of a larger portfolio. Like, they're not looking at a 20 unit. They're not looking at a 50 unit. It's just not, it's not worth it. They have too much capital to place. It's too inefficient on their end. But you have to have quite a bit of a sizable package in order to deliver to them. So you're helping to bridge that gap, and I know you guys have your, your fund and whatnot. So you do provide an avenue, an on-ramp for investors to be able to partner up with you guys. Because, hey, it does sound like a lot of work. I know what it's like, we know what it's like to close, a 100-unit complex, and definitely know what it's like to close, a single family. And yeah, to do that many of them at scale and at volume, that's a lot of freaking work.
That's the funny part, is closing a single family home and closing a 100-unit complex are very similar. They require a very similar amount of work.
Yeah.
you have to do the same type of work on title, the same type of work on survey, on renovations, et cetera. I mean, obviously there's more units, but it is, that part of it is scalable, right? You're deciding on the layouts, you're deciding on what kind of renovation you're going to do. And typically you've only got one contractor, whether it's 100 units, you got one GC, or whether it's a single family, you've got one GC. So in many ways, that is not a super scalable thing to have that many closes. And so what we're focused on is building out a model and a system. And I think we've done a good job of that, but are constantly working to improve it, where we can make that, sometimes 5, 6, 7 closings in a month not be something that overburdens our system. Because at the end of the day, what we want to be able to do is keep adding markets, keep adding per month volume. We always think about our intake units on a per month basis. And if we're in, 4 good MSAs today, we want to be in 10 in a year. And we want to make sure that our system is such that that is something that we can expand to easily without shutting down and just getting overloaded. So it's got its difficulties. There's no doubt about it.
Well, I mean, that's part of it too. I mean, we've done this in the past too, where it's like, well, you can cast a wide net, and that does help you to scale quickly. But again, if you've got too many moving parts and you're too spread out, that can be hard too. But it sounds like you guys have, and like we run into this a lot, with let's say flipper contacts. Okay, I got my contractors. Yeah, but if you go too long in between, projects or whatnot, like it's hard to keep these guys. So it's like, but if you have enough projects going on, hey, no problem. Like we've got we've always got more we've got more on the table. We've got more coming down the pipeline because you have these kind of smaller deals that have repositions and they need the work, frankly. You can keep these guys active and ready and boiling and, ready to go. And that's a key differentiator, I think.
Yeah, we call it our beachhead in every market when we get started there, getting that first set of contacts together. But over time, it builds into this ecosystem of contractors and architects and engineers that do surveys for us and look at structural concerns and all that kind of stuff. And in some ways, it's interesting. The part of that ecosystem that's technically Terra Capital is, our own little cordoned off part for the people that are 1099s and W-2s for us. But when you expand the contractors and some of these other people that are in there, a lot of them are working almost exclusively with Terra on projects, and we've built their business sort of alongside them. And so there may be, 3 guys that have done renovations together for a while, but now it's a crew of 8 or 9 guys that are doing, 4 or 5 units for us a month in that market, renovating it. And so it's, as you said, you build out that, long-term relationship with these people. And in the same way that you've got to build out your relationship with people like agents and brokers, although we've gravitated a little bit more towards that off-market side of things. But the more that, in the same way that you have to build out those relationships, you have to build out relationships with contractors and have a true rapport with them and be able to trust them and know the type of work that they do and also train them, right? There's a certain outcome that we're looking for that is not off the shelf. So it's a long-term investment in any market where we're playing.
Yeah, good to see you, man. And like I said, that's you're doing it right, and you're kind of solving some of the problems along the way that we would typically see, with different strategies and whatnot going into these different markets. So no, that's awesome. And I do want to talk a little bit about the markets that you guys target, because you're specific in what you're going after. You guys aren't necessarily buying it. Who knows? Maybe not right now, but you're not picking up stuff on the West Coast or in California, from what I understand. So tell me a little bit about the markets that you guys are servicing and that you're operating in currently, and why those markets.
Yeah, so we are market long-term people. We don't want to pick an asset class and be market agnostic. We want to pick a location and, as I was saying, build out that ecosystem because we need it in order to operate. But when picking our markets, we had the opportunity to step back and look at really every MSA in the US under a microscope and with a framework that we put together to really grade and rank each of these markets and decide where we wanted to go and plant a flag. And so what we've kind of honed in on is, we're laser focused on recession resistant markets that did well in the 2007, 2008 financial crisis, right, are over-indexed in really sticky, recession-resistant industries like healthcare, education, medium cost location business services and tech services, government jobs. These are the last to be laid off folks that won't be affected by a recession, but generally do benefit from good economic times as well. And we also want markets that have strong underlying real estate fundamentals, population growth, affordability, things like that. But they're balanced with still having a healthy level of competition, right? So we're not really keen on a market with 10, 12+% population growth, because that is subject to change at any given time. And it might not have the quality population growth that comes along with it. It could be fantastic population growth, but what comes along with that is a lot of competitors looking to do the exact same thing, right? So we want to focus on markets where the competition is healthy. We're playing against people, we're competing, but it's not so oversaturated that prices are getting driven through the roof. And there are a lot of markets where that happens to mini multi, right? There are some examples of that in certain neighborhoods in Chicago. Virtually all of New York City looks like that, right? It's because of the way that air rights work there. There's a bunch of skyscrapers and then a ton of really small brownstones. So a lot of the overall square mileage of housing stock in New York City is in mini multi, which is actually where we started. And it's so competitive that even a 4-unit, 5-unit property is a complete, 100%, 50, 60 people looking at it and bidding on it type of process. So we want to avoid things like that. And the last thing that we're really focused on with markets is regulatory risk. It's not enough these days to just pick red states or something like that. You have to really do your research to understand what the medium and long-term regulatory risk is for landlords. And it's significant. And some of the markets that have higher risk, or that we gauge as having higher risk, might surprise you, but we do our research on them and we avoid them. But when you have things like rent reform, rent control, and things like that, it ruins the whole point of real estate, right? It's supposed to be something with upside, but is limited downside risk, and doesn't have a lot of government involvement. And obviously our residents, we manage everything ourselves, and our residents are very important to us. But markets where the tenant landlord regulations are overweighted in one direction are just unhealthy. So we pick ones where that's not the case. So the ones that we're focused on right now that fit these parameters perfectly: Pittsburgh, PA, Columbus and Cincinnati in Southern Ohio, and then Indianapolis. And those markets are surprisingly very similar to each other. They're all about 2-hour drive time from where I grew up in Cleveland, but they are culturally similar. They are economically similar, and they have very similar trajectory and performance over the last 10 and 20 years, and projected performance over the next 10, and have similar opportunities for upside. They've got a lot of that medium cost location tech stuff coming in, whether it's Google or Amazon or Infosys or the chip factory in Columbus. It's, generally positive news, but not explosive out of this world news. Because at the end of the day, our returns are driven by buying really well for low prices, renovating really smartly, managing everything internally to drive cash flow, and then portfolio arbitrage, right? We're not getting returns by betting on markets. We're getting returns by adding value. And so we want our markets to be good, not out of this world and not bad. We want good, strong, solid, long-term growth markets. So that's where we're focused. And maybe it's not, the first thing that comes to mind when you're thinking multifam, but these markets have served us really well. And I think they will continue to do so for the foreseeable future.
Yeah, no, that's super solid. Like I said, I think your acquisition strategy, for one, just building in the additional discount when you enter in, you already have some built-in protection, and you guys are adding a ton of value through the reposition. And, so you got multiple items there on that to create value to kind of protect yourselves as well. So, and you do it in a solid market, that's a winner. It doesn't need to be, Phoenix or some of the other places that have just exploded, but then you've got the crash, that comes kind of on the backside of that too. And the volatility helps that creates for an inconsistent product, right? Especially when you're trying to aggregate a bunch of these into kind of larger portfolios. It's like, well, shoot, I got these at, 50 cents a dollar, but these guys are, much closer to, we had to play, almost full market value just to be able to pick them up. And it's like, well, that, it doesn't make sense. You kind of rather have a whole package portfolio here that you can move on, that it's all consistent product. We got them all around the same kind of numbers, and you have a nice, stable, solid market to deliver them in. Yeah, it's a winner. I like it.
Yeah,
I like
Phoenix
it a lot.
is a good example of a market that's a fantastic market. I would love to be invested there because I wish that I had invested there 10 years ago, right? But it doesn't mean it's a bad market today. It just means that it's difficult to scalably get good deals there now. So it's a great place to be if you've been there. It's a difficult place to go if you haven't. And, maybe it's not the right place for you right now. But ultimately, the way that I like to kind of frame it in my own head is that there are some people in real estate that are very good at acquisitions. Mm-hmm. And you can make a whole career out of that if you're wholesaling or whatever it is that you're doing, right? There's some people in real estate, sometimes they're contractors, sometimes they're, different types of folks that are really good at renovations and thinking about the specific value add part to it. And you can make a ton of money there as a contractor. Similar in property management and asset management, if you're really good at running buildings like that. And then finally, obviously, you've got brokers that are really good at buying and selling. And so what we're trying to do is really bring together those four main components of adding value and say, okay, I bought this property at what I think is probably 30% below what maybe it could sell for in a process. So day one, I've got great value. Then I renovate it and I get that regular value add margin on top of that. Okay, great. I've now got that value. That's locked in now that it's renovated and leased up. Then I'm managing that property and I'm boosting cash flow by 10% because I'm bringing in these strategies and tactics and forms that we've used in competitive markets like New York, and we're bringing it to the Midwest, and they're really effective. Okay, so I've locked in that value now because I have higher cash flow. And then finally, the last piece of it, which is, one of the things that kind of differentiates us from other multifam opportunities, is that because we bundle and aggregate the large portfolios, we take advantage of portfolio arbitrage and groups that pay more per unit because there are 200 of them than anyone else would per unit if there were 10 of them. Yeah. And so that is that last kind of piece of taking value from the value chain. So we're trying to hit on all four of those cylinders to really drive maximal returns. But it's not easy to be any one of those things. And I certainly am not claiming to be a master in any one of those things. But I think Terra has been able to get a really good basis in each of them by bringing in people like Tom with his background in renovations, some of our other folks that are property management sort of extraordinaire folks that really do a good job of management, so on and so forth. So, we've cobbled together something that is, hitting on those four key parts. But you're very right. Those are all the, ways of locking in value early on and being able to be sort of secure in the work that you've put into something already.
Yeah, no. And the other component here too, and I'll give you a quick second to kind of talk about that. I know you guys have your fund because the debt side, the capital raising side, that's another key component. And a key differentiator, I think, between what you guys are doing versus most, let's say, syndicators or most flippers. How do we raise funds for this? It's like, well, you're not necessarily just going to go your hard money lender if you're a single family guy. If you're a syndicator, it's like, okay, well, we can go, agency debt or something like that, along those lines. I mean, you're going, you need something a little bit more flexible, a little bit nimble, especially when you're doing so many acquisitions. You need to kind of move with some urgency and some speed. What's a solution that you guys have come up with in order to kind of solve that problem?
It's maybe not the most interesting part of what we do, but it's one of the things that was most difficult to get over is having lenders that can operate in this broad band range of anywhere from 2 to 20 units, right? There's a big difference between a duplex and a 20 unit building and so on and so forth. So, and it just in general, that part of the market is broadly underserved. And so everything that we've done to fill that gap is purely custom. And so we've negotiated special line of credit arrangements with a series of, at this point, really 7, maybe 8 lenders that work with us at entry on every deal. But I'm not kidding when I tell you that our total list of lenders that we've reached out to discuss this with and start negotiation, I mean, it's over 300. And there are so many small, especially private lenders out there that we've had these discussions with everybody. And then finally, we've been able to build good relationships and have setups with it. But the way that we generally do it is every property that we enter with a construction loan. And so they take a significant part of the purchase price out. So we reduce our equity basis. They fund all or the vast majority of our renovations. And then we take advantage again of a little bit of portfolio arbitrage by bringing not one 5-unit property, but maybe 30 to 40 units of fully renovated, finished, leased up property to a typically local bank that will give us really, really good terms as a bundled deal for a long-term financing arrangement that looks more like a 25, 30-year AM type of typical mortgage structure. And we still see, rates in the high fives. And so if we can hit that, then that's great, especially when we're, building on average to over a 9% cap rate. And so that is the way that we have handled leverage for the last 8-9 years or so. And it's a good process, but we're constantly working the capital markets, and similar to our contractors that have grown alongside us, we've almost built out this kind of lower middle market product with a couple of lenders, and they might be comfortable every once in a while doing a 4-unit or comfortable every once in a while doing a 10-unit, but we've set up a line of credit system where they are regularly and repeatably doing it with us. And so that's worked out well. And then on the equity side, we have to be structured as a fund because of how high volume and how small some of the equity checks can be sometimes. I mean, if we have done deals where the equity check's $100,000, how could you possibly syndicate that, right? But it's a 3x deal. People would love to do it, but nobody wants this. Nobody would have the time, attention, and afford the lawyer fees to go through all of the documenting for a triplex in Indianapolis, right? So we have done it in a fund structure, and it operates similar to a line of credit in a lot of ways. We have a very strict approval process. We have a very active board of directors that overlooks our investment committee meetings on every single deal. So everything is reviewed in excruciating detail and approved by third parties, some of whom are not invested directly in the fund. And so there's a lot of oversight that goes into deploying capital into a deal. But at the end of the day, it has to be structured that way. And it works well. And I would say that our investor base snowballs. Everyone that's been with us early on has stayed with us now. And we will bring in new groups with, maybe smaller check sizes to start. But over time, it's the next fund. They do a larger stake, next fund, larger stake. We have a syndicated deal that we came across off market. They want to take that, and we offer that to them as kind of a bonus for being invested in the fund, is that they get exclusive access to a 60, 80 unit deal. And that's how we've been operating from the capital side. And that's been going well too.
Oh, that's awesome. Yeah. You guys have a lot of moving parts. And like I said, I think your unique strategy is probably it opened up some other key doors as well. So very cool. Very, very cool. Well, I want to, this is a point in our show where we kind of transition to what we call our fire round. So like just, kind of more rapid fire, kind of brief question answers. And is that something you're up for?
Yeah. Fire away.
All right. Right on. What is the best book that you recommend other than Rich Dad Poor Dad?
Rich Dad Poor Dad's a good one. My best book recommendation is Ron Chernow's Washington. It's the biography of George Washington.
Yep.
Amazing story. It's as much about hard work and determination as it is about networking, presenting oneself. And probably the most important takeaways from that one are crisis management, which you can imagine was 95% of George Washington's life. But I think in general, biographies are a super helpful way to learn and self-improve, because they're the naked truth about somebody, right? They're not just you need to do these 10 things well. And it's almost unrealistic expectation that you can accomplish that, especially if you're reading 15 books like that each have their own 10 thing. How are you going to do 150? But it gives you the naked truth about how somebody who is exceptional dealt with it.
Yeah, no, I love that. Yeah, very, very good. And I've heard his biography recommended before. Yeah, it's key. It's great to be able to learn from some of these titans of the past that too often we overlook. It's always like, hey, who's the latest and greatest? And it's like, yeah, but they're probably drawing from principles that are kind of timeless there. So yeah, no, I like that.
Yeah, he's one on Rockefeller and he's one on Grant that are both also chef's kiss.
All right, awesome. Make sure you guys check those out and you hear those recommendations. I'm going to look them up. What would you consider your superpower is? You guys had a lot of moving parts. You got a lot of stuff going on. What's your superpower?
It's keeping them all together. Systems, processes, automation. That is my skill. Building something that's scalable is what everybody wants to do, for sure. But my superpower is being able to make sure the nuts and bolts are in the right place, that I can move the key people into those roles where I need them and shift people that are, not doing well where I wanted them into some place that they can succeed. That's what I do well. I love what I do, especially the rush of a deal and negotiations. That's what drew me into real estate. It's one of the shames. It's one of the big tragedies of growing a business in something you love is that you can't do it anymore as much, right? So I'm not participating in negotiations as much as I would love to do, but it is putting the systems and processes together and putting the right people in the right places. That's what, as it turned out, is what so happened to be my skill.
That's awesome. And it's absolutely vital. You don't have all of those pieces of the puzzle that come together without that key superpower. So yeah, no, very, very necessary. What's the biggest lesson that you've learned over your career thus far?
Biggest lesson is ultimately that nobody has all the answers, and most smart people, not just some smart people, but really most smart people, are wrong a lot, whether that's financial crisis, stock market, whatever. You watch a movie like The Big Short and they profile a couple of super geniuses that figured it out. But for every super genius, there's 10 partners at Goldman Sachs or whatever that you would consider to be very smart people that missed it or got it wrong. And so in order to succeed or cut out a part of a market that's good for you, you really have to think for yourself. And I think that we are conditioned to think that people in power and people at the top of any organization really know what they're doing and are super competent. And I think, the more exposure you get to folks like that, the more surprised you are to learn that it's not true. A lot of those folks are as clueless as anybody, or in some cases, much more so. And that's why there are frequent catastrophic failures in the economy or any company every 5 to 7 years. And it's the obvious rule staring people in the face that they don't realize, but it's true. And you can't just take somebody at their word. You gotta think it through yourself, or else it's meaningless.
Yep. No, that's good. And we see that play out time and time again.
Every few years, right?
All right. For the busy working professional working towards, financial freedom, what advice would you have for them?
Yeah, I think it's probably twofold. The first is define what you want with your financial freedom. I think a lot of people have a hard time retiring, right? So like if you want to be working hard and be very productive and have a lot of stuff to do, then there are certain things that make sense for you. And if you want to not do that, then there's a completely different set of things that are more passive and potentially more profitable in the long run, but are much less intensive. And then the second one is, if you are well suited to invest in something and do something, buy a car wash, buy a small property, buy a whatever laundromat, like in Breaking Bad, whatever that might be, you might have all the skill in the world that makes sense to do that. And if so, go for it. If not, don't do that. And instead find sponsors with good track records that you trust, invest with them. If they do well, keep investing with them. Ask about upside and downside cases. Ask about how the investment is protected in catastrophic downside. Ask what happens in a recession. Ask about whether returns are net or gross, right? Which is one that people never realize, and they get pitched a 4x investment, but it has massive Lehman scale fees and they end up with below a 2x, right? And so learn all those things and then hedge your risk, let a professional do it, invest with a few different groups like that so that you're placing your capital across a couple of different things, and don't get your net worth tied up in a money pit that you're never going to understand. If it's not your calling, if it is, right, do it. If it's not, there are other people that do it very well. And I can tell you firsthand experience being somebody that is a sponsor in this space is it's not every morning waking up with sunshine and roses, and you might not want to be that person. I love it, yep, but you might not want to be that person.
And even though you love it, there's still mornings that you wake up and you're like, ah, crap. You know?
Exactly. And it is like that by design in this field, right? No roof lasts forever. No boiler lasts forever. And at some point, you're one step above the day-to-day mayhem of that, but you're never more than 3 steps above it. So you gotta keep that in mind.
Yeah, absolutely. Well, Ray, it's been great having you on the show. If our audience wants to get in touch with you, what's the best avenues for them to be able to do that and reach out and kind of if they've got questions or if they just want to connect with you personally, where can they do that?
Yeah, best thing to do is go to our website, Terra.com. We've got a lot of interesting stuff on there that talks about our strategy and has some renovations and some 3D renderings that of renovations we've completed. But it also has a couple of resources where you can send in a message there. It has our email. Feel free to send us a note. We love talking about multifam, so we are not shy about having a conversation, no matter who you are, whether you're an interested investor or whether you're somebody who wants to learn more. We enjoy being part of that broader community. We are very active on LinkedIn and Bigger Pockets as well. So we post there all the time. So if you're interested we try to keep our posts related to stuff where we know what's going on. So there's a lot there about mini multi, the history of mini multi, Midwest markets and what makes them good and what's going on there in some of these tier 2 markets that might not be in the front page of the journal. So would invite you to follow us on Bigger Pockets and LinkedIn too, and continue to be part of the conversation there.
Awesome. Sounds good. Well, Ray, thanks again so much for coming on today. And I think our audience got a ton of value and maybe some fresh perspective out of our conversation. So I really appreciate you coming on. Much success to you and the team in the future. And we look forward to staying and keeping up with you.
Excellent. Thanks, Steve. Appreciate it.
Absolutely. Have a great one. Aloha. Oh, awesome episode with Ray Hyman with Terra Capital. Well, they've got a completely unique strategy going after the mini multifamily units. The not your traditional 1 to 4 single family, which is still considered residential, but they're more operating in the space of 5 to 8 to 20 units. Kind of some of these basically carving out a blue ocean for properties. Again, they're just too big for most residential investors to go after, but a little bit too small for institutional players for sure, and even traditional multifamily operators. So awesome job in creating a unique strategy, packaging all of that together to go, market to institutional capital down the line once it's hit, 150 units, 200 units, 250. Kind of a larger package portfolio. So super smart strategy. Obviously a very talented and very smart guy there, Ray. Shared a ton of great nuggets with us. And I highly encourage you to go back, listen to the episode again, peel away any gems that may have stuck out to you. But I think he's got an awesome strategy. Guys, if you're interested in investing with us, go to tricityequity.com, of course, to learn more about, the projects that we've done, the things that we've got going on. Or if you just want to connect with any of us, any of the partners, connect with, of course, other like-minded investors. And if you're here local in Hawaii, make sure you're joining our Facebook group, Honolulu Multifamily and More. We have monthly meetups. So if you're in the market, whether you're visiting here on vacation, or if you're based here in Honolulu, make sure you're checking us out. We'd love to meet you face to face, shake a hand, make some new contacts here in the market. Of course, if you found value in the podcast, Please subscribe and give us a 5-star review. We'd love that. Even if you hated the show, give us some feedback too. Let us know why. We always want to make sure that we're improving in whatever way possible. So we want to make sure that we're servicing you guys the best that we can. If you know anybody who might resonate, of course, with the message today or any of the other shows, if you've checked them out, please make sure that you share the podcast with them. And, of course, we do have the Hawaii Millionaire Mindset Conference coming up June 29th through July 1st. That's just coming up just right around the corner. So if you haven't bought your tickets or made plans to be in Hawaii, make sure that you're planning to do that. That is over on the Big Island of Hawaii. You can go check out the volcano. You can go check out snow on the top of Mauna Kea and experience an amazing conference. So make sure that you make plans to be there. All right, guys, that's going to be it for today. Signing off, Steve Fieros. Go out and take some action, and we will talk to you guys soon. Aloha.